Hey, welcome to our presentation on the three fee forms. The focus of this tutorial is to provide a working knowledge of the different forms used to quote rates and costs and build confidence for good decision making. Loan charges will flow through three different forms during your mortgage process. Many people start their search for a lender by requesting quotes, which will likely be provided on a fees worksheet. This fees worksheet is really a tool that should be used to have a conversation with the lender about fees, but not to be relied upon because it's not an official agreement, and rates change every day. If you'd like more information about this, be sure to watch our shorts on how to shop for the best mortgage deal and how interest rates and closing costs are related. Once you're under contract and in position to lock in your deal, you'll receive a loan estimate. Laws require lenders to supply all home buyers with an official loan estimate within 3 days of a complete loan application, which includes a property address. The loan estimate has protections against a lender changing their fees for no reason. However, you may receive several revised loan estimates during the processing of your loan if there is a valid reason for a change. The fees worksheet is likely the form you'll see first. It's a good faith offering of information, but not a guarantee of any kind. If you're working with a reputable company, then their fees worksheet should closely resemble the offer they would make if you were ready to lock in your deal. It's a straightforward document that shows a concise breakdown of everything you need to know about the transaction. The top section is an itemization of closing costs and prepaid items. The bottom is a transaction summary that includes charges, credits, and a breakdown of the monthly housing payment, including property taxes, homeowners insurance, mortgage insurance, and homeowners association dues. It also shows the amount you'll need to wire to the attorney's office and the total monthly housing payment. Digging deeper, the closing costs are made up of origination charges, which are fees charged by the company that's helping you to obtain the financing, and other charges, which include everything else except for the prepaids, which are costs of owning the home that are collected at closing, as opposed to costs that are incurred during a home purchase. So homeowners insurance and property taxes are examples of prepaid items that are collected at closing. And attorney's fees and title insurance and recording fees are examples of things that are charged because you're buying a house or getting a mortgage. Those would be closing costs. So once you've entered into a purchase agreement on a property, you'll receive an official loan estimate, which organizes the same fees from the fees worksheet into different buckets. These 7 categories were designed to provide protection against unwarranted changes after you've entered into an official agreement. Since you're already familiar from looking at a fees worksheet with the closing costs and prepaids, let's organize the fees categories from the loan estimate into closing costs and prepaids. So when you set the two documents side by side, you can trace how the numbers flow from the fees worksheet into the 7 categories on the loan estimate. Comparing the two documents like this is cumbersome and confusing. Even if you do a line-by-line comparison of each fee, you are still left with questions and a lack of confidence in the numbers and probably your loan originator, particularly when you notice that the closing costs on the loan estimate are thousands of dollars higher than the fee worksheet. It was a very poor decision for the bureau in charge of creating these documents to change the definition of closing costs from one form to the next. You'll hear me rant about this on several of the videos. I just want to make the point clear. Closing costs are fees paid to buy a house and get a mortgage. Prepaids are fees involved in owning a home that are paid at closing. They should be separated, and on this document, they're really not. So I've developed a process that will help you compare both closing costs and prepaids on the fees worksheet and loan estimate. Please follow carefully, and if you have any questions, call me, or you can chat with me anytime at foundrymortgage.com. Following the format of the initial document, the fees worksheet, we'll search for the closing costs first, and then the prepaid items, then the cash to close and the credits and everything. But we're going to start with the closing costs. So first, note the closing cost figures from the fees worksheet. Then add items D, E, and the owner's title insurance only from item H. In our case, these numbers add up to $6,522, which is $370 more than quoted on the fees worksheet. So in order to find that $370, we start looking individually through the items on the fees worksheet, and what we find first off the bat is that the appraisal fee is $300 higher than was originally quoted. When the buyer chose their property, they chose one with acreage, which resulted in a higher appraisal fee. There was no way to determine this at the point that the conversation began with the borrower, so this is a legitimate increase in a fee. It was explained to the buyer up front, so this was not a surprise in this case. Now, following the prepaids from the fees worksheet to the loan estimate is easy. However, estimating property taxes and homeowners insurance can be tricky, and unfortunately, many loan officers don't practice enough diligence in researching the property taxes and homeowners insurance costs, or worse, will underestimate them to make their quote look more attractive. In this case, the initial quote showed $51.39 as the estimated prepaids, and the actual number was much lower at $38.27. A quick look at the items under sections F and G shows us that the borrower was able to find a homeowner's insurance policy at a very low premium, which translated into lower cash at closing and a lower monthly housing payment. A quick check on the credits shows that all credits were transferred correctly from the original quote to the loan estimate. The cash to close is lower by $942, principally because of the lower homeowner's insurance quote. Comparing the monthly housing payment, we see how the homeowner's insurance created a much lower payment than originally quoted. This is a good example of why it's difficult to compare lenders' fee worksheets in order to determine who has the best deal. An underestimated tax or homeowner's insurance cost could make a good false impression. If you're interested in learning more about how to compare lender quotes, watch our short on how to shop for a mortgage. A quick tip is to compare origination charges at the same rate. Ask for a range on the same day. This will keep everything apples to apples. Thanks for watching part 1 of the 3 fee forms. Part 2 of this video series will help you prepare for your closing by explaining how the loan estimate compares to the closing disclosure. Keep the link to this video handy and review it when you receive your official loan estimate. And if you'd like a download of the slides from this presentation in PDF format, please go to www.foundrymortgage.com/insanity. Hey, there's no substitute for choosing a lender that you're confident is working in your best interest. We encourage our customers to shop because we're confident in our ability to deliver the best advice at the best price. Come chat with me anytime at foundrymortgage.com. Have a great day.